There will be outrage. I'm your host, Steve Van Metre, and thanks for joining me today. A tax shock is coming, and I can tell you this, you're not going to like it. Let's head over. We picked today's story up with a headline: taxpayers can expect refund shock when they file their 2022 tax returns. Thanks to pandemic relief measures passed by Congress in the last year of the Trump administration, and especially during the first year of the Biden administration, many Americans got big tax refunds earlier this year, but don't count on a repeat. And this is going to be a challenge for a lot of people, because when do you find out about your refund? Well, you find out when you file. And for most people, that's actually next year into the early part of it. And this is a problem because, at least from the onset of this, there's a lot of people that under withhold during the year to count on their refund to bring them whole. And this time they're going to find out they might owe a lot more than they think. We call it a refund shock or a refund whiplash, and it really has to do with a lot of tax benefits put in place last year as part of the way to combat the pandemic. A lot bigger credits, a lot more credits, stimulus money, and a lot of that went away at the start of this year. The average refund for 2021 was well over $3,000, more than 15% above the pre-pandemic refund in 2019. But Stieber says expect a big drop in your tax refund for 2022 because these credits in particular were not renewed. And so as we think about the economy, we think about spending, a lot of people, again, not just from the fact that they under withhold during the year and rely on that, they count on that to catch up with their bills, their credit card statements, the holidays. There's things that they count on, and this time they're getting used to it. And this, what they're going to find out is when they go to file, that number's not even close to what they're expecting. The child tax credit went up to $3,600 per child, fully refundable, and now that's back down to $2,000. The dependent care credit, which went up to $8,000, dropped back to $2,100, and while the earned income tax credit for taxpayers with no kids dropped from $1,500 to $500, and those are big drops. And another credit lost to most taxpayers who filed the unitemized return, the charitable tax donation. Last year, as part of that pandemic package, they put into place a special charitable deduction above the line if you don't itemize of $300 or so per person. That's gone. And this year, only 9% of taxpayers say that they can itemize their taxes, can deduct the charitable donations. With 1 month to go before the end of the tax year, is there anything taxpayers can do to maximize their refunds? And the answer is, well, not a whole lot. And that's the problem, under the new tax laws, because most people end up with the standard deduction. And this is going to become a shock because, again, you're going to see these big credit card bills coming. You're going to see other bills coming, and people aren't going to have the money to pay it because their refund's not there. And again, as we look at credit cards, the timing couldn't be worse. Credit card balances jumped 15%, the highest annual leap in over 20 years, as Americans fall deeper in debt. More consumers are now relying on credit cards to get by, which has helped propel total credit card debt to a whopping $930 billion in the third quarter, just shy of an all-time record, according to a new report from the Federal Reserve Bank of New York. And making that worse, credit card balances not only are back to pre-pandemic levels, but consumers are also carrying them for longer periods, suggesting that consumers are unable to pay them down. Of course, we know that's a problem for them because interest rates have gone up so much in such a short period of time. Among Americans who carry credit card debt from month to month, whopping 60% have been in credit card debt for at least a year, a staggering amount. And we start to ask the question is, why is this happening? Is this simply because the Fed raised rates and this is causing people some undue harm that they can't keep up with their minimum payments, so they have to carry those balances longer? Well, the real problem is that it comes back to the economy, the fact that wages just aren't keeping up with inflation, meaning consumers have to choose between paying on their debt and either putting a roof over their head, food in their tummies, and providing their fuel for their vehicles and their houses. Here we can see the consumer price index in blue against the average hourly earnings of production and non-supervisory employees on a year-over-year rate of change. And we can kind of note during expansions, it's not unusual to see that average hourly earnings are higher than the rate of inflation. And this is what really booms expansions along the way. But notably now, what are we seeing? A big divergence between the two. We can see that Average hourly earnings for production and non-supervisory employees are far less in terms of their growth rate than the consumer price index. And all this means is credit card balances are going to continue to get higher. And the Fed, well, they're not done, at least perhaps not yet. Since most credit cards have a variable rate, there's a direct connection to the Fed's benchmark. As the federal funds rate rises, the prime rate does too, and credit card rates follow suit. Cardholders usually see the impact within a billing cycle or two, as we've talked about on this show. And already, credit card rates are roughly 19%, an all-time high, up from 16% earlier this year. So I want to paint this picture of the first quarter next year as people go and file their taxes. At the same time, due to the lags of the federal funds rate hitting credit cards, they're going to face even higher interest rates, higher minimum payments, on top of the fact that they've got their holidays charged on those cards. It's going to be a brutal reality that is likely to end with people spending less. Further, those rates will continue to rise since the central bank has indicated even more increases are coming until inflation shows a clear sign of a pullback. At least that's their plan for the moment. The best thing you can do, as we talked about on a previous show, is pay down high interest debt with a 0% balance transfer card. Otherwise, try to consolidate and pay down credit cards with a lower interest rate personal loan, because rates on personal loans may be less than you're paying now. But if consumers got the message yet? Well, not exactly. They're still spending outside their means. Here we can see that personal incomes for October were up 0.7%, which was really a nice number. But check this out. Personal spending was up a whopping 0.8%. Again, continuing the trend that consumers are spending more than they make. And we know where that's going. It's going on those credit cards. And from an inflation adjusted standpoint, real personal consumption was up 0.5%. And here what we can see in this chart is personal incomes. Now they have trended back up and are kind of running right around where they were at pre-pandemic. And personal incomes look at all income sources, including government transfers. But notably here, we're seeing even that overall trend, as we've drawn with the yellow arrow, starting to head lower, as you can see here, and that is not a good sign for consumers who are just facing big credit card bills, lower tax refunds, and high inflation. When we look at real disposable personal income, real meaning inflation adjusted, disposable, what you've got left in terms of your income after inflation, we can see and we know it's negative. As many of you said, that you have less money to spend now than you did in years past, and certainly that's evident by the government's own data. But will that put things to a stop with the Fed? Well, sooner than later, they will get the picture. But now let's look at personal savings rate, because this is the money that people have left over to invest, according to the government. And I want to tell you, this is perhaps one of the most shocking charts we've seen in a while, because let me show you where this number is. It's not just close to the all-time low, it's right near it. And this is data going back to the 1950s, suggesting the personal savings rate is in a terrible area. And of course, as we now know, consumers are not only just going to face higher inflation into next year, they're going to get a lower refund. They have less money to spend. Their wages aren't growing fast, and they don't have the savings to cover these big bills. And all points to the fact that somewhere in the first quarter, spending is going to go way down as people find out their refunds aren't what they thought. I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.